had done 150 odd interviews in finance and I just wouldn't land a damn job. If the world would not give me opportunities, I'm going to create that opportunity for myself.
Yoga Bar was always around, but it sort of burst into the pink papers when the 500 crore ITC deal happened.
We've grown 4x from the time ITC bought us in a time span of less than 3 years.
So you've actually probably outperformed the...
We have outperformed our original plans.
You never chose to go down the celebrity route or even television ads and so on.
My consumer's not making a rich person richer. Bring us a better product at this price point and we will return your money.
Having a large market share is much more important than having a large
revenue base out of categories that are largely commoditized. The ability to generate profit from a business compounds when you...
Suhasini, your story is fascinating. A chartered accountant who became a health food entrepreneur, right? You very hard to make that bridge. You started at KPMG. How did that journey happen? What were some of the insights along the way that drove you to feel like you could start in this category?
Actually, funnily enough, Sandeep, I wanted to get into finance. Okay, not like I interviewed
Really?
with BCG and all of that. And I probably interviewed with every private equity fund because I think commerce, I think accounting ran in my blood because my dad was also an accountant and a lawyer and a cost accountant and all of that, right? So I knew that I wanted to be an accountant when I was very young and I wanted to be in finance. But every interview I would do, and I would do an iBanking interview, I would do a private equity interview, I would get to like the top 3 people whom they're selecting for the job and always fail. And the person's feedback would always be, you're too independent minded, you should probably do something of your own. And I feel like the universe made that call for me because it seemed crazy that I had done 150 odd interviews in finance. I had the absolute CV for it because I was a CA ranker, I had done my MBA in finance, and I just wouldn't land a damn job.
But really, this sounds bizarre that, somebody who's a CA ranker, went to LBS, did course at Wharton, wouldn't get a job.
I just didn't get a job. I remember I even did my summer internship at Multiples Private Equity, and they were just like, we were so happy to get rid of her because... And I just don't know what it was. I feel like the universe had a plan or something because I can't explain it. I didn't even land a job as a Microsoft finance manager. And the person interviewing me was probably, and my accounting knowledge was fairly thorough because I did quite well in my career at KPMG. So I knew all the nitty-gritties of accounting. I wouldn't land an accounting job. I can't explain it to this day. I can't explain it, but that's what happened. That's a true story. But I think what was important was I realized that if the world would not give me opportunities, I'm going to create that opportunity for myself.
Yeah.
And I think at that point, I didn't take it upon my confidence. I truly believe that I'm spectacular and maybe I'm too good for this and I should figure out how to make something out of my life.
Absolutely, absolutely. I want to switch back to the yoga bar story and actually talk to you about how yoga and bar came to get attached to each other. What was that moment in New York, I'm told, where you figured out that such a gap exists?
Yeah.
And also then how did you actually make that happen?
Yeah. So my sister and me were living together and we used to go to this yoga class. By that time, it was decided that I'm going to figure out what business I want.
Because you're not getting a job.
I'm not getting a job. So she's like, at least while you're not getting a job, make sure you at least go to a yoga class and don't get too fat. So both of us used to go. And then after the yoga class got over, we used to go and eat this bar called the Kind Bar. And we realized that there was nothing in India that was healthy and clean labeled at that point in time. But when we took that bar, she's like, I would call it yoga bar if we created this in India. And I'm like, let's trademark it because we don't know at some point of time we might need this. And between the time of trademarking and actually starting the business, it was 3 years.
Wow. Okay. So you were holding the trademark without running a business.
Without running a business. Because in the US, the trademark is right to file. In India, it's of course right to use. So the trademark in India was only valid once we started doing the business. But at least the trademark in the US held just because you filed it. So nobody else can use it.
And was it clear that the both of you would come together to do this? Because Anandita, your sister, already had a job. And so how did you both think about it?
I don't know, at that point of time, I don't think we thought that much ahead. So I came back, did the accounting outsourcing company, which has done reasonably well. But at some point, I met Kaval along the way. My mother started making these bars for me. So whenever I used to be in a board meeting, I should represent the finance team in some of these startups. And he had some
So
faith and said,
Kamal at
Kaval at
Fireside.
Fireside.
Yes.
Once he had some faith, I made that call to my sister and said, maybe we can make something out of it now because someone's willing to invest in it. We're talking back in the day when Flipkart was still $1 billion company and there was just no startups at that point in time, right? So his validation definitely helped us take the next step.
And when you think about the economics of, let's say, the final product, let's say it retails at $100, like how would the margin profile look? What are the cost lines that break down of this 100 rupees?
You have the retailer and distributor margins. So you hive off about 35%. Then you had GST, which in our time was 18%. Now it's come down to 5%.
Yes.
Then, of course, you have your own entire cost, which is the cost of raw material, cost of packaging material, cost of overhead, the absorption costing of running. Like if you have a senior hire in your managing your CEO costs also have to be apportioned. So all of your variable and fixed cost to take the product to market has to be properly, like you have separate cost sheets. You go line item wise, and then you have a margin profile. And a healthy margin profile for food is 40%. After all of these costs are gone.
And today, Suhasini, when you see per capita income rise and potentially people investing in themselves, and food is one big part of it, what would be your advice to a new health food entrepreneur? Like, what are some of the things, do's and don'ts that they should be aware of?
I would say one is you should always give value to the consumer. We built our business around the consumer, including the price, value proposition, and how a consumer feels when they consume our product. And that to me was very important if you have to build a large scale business. A lot of the new health food brands serve the top 1% without adding the value for the top 1%. If I'm a top 1% consumer, I want my calories to be 100 calories and I want a very scientific product, which a lot of the new age, you're just taking the same product that everybody else takes and doing complex marketing and branding and then serving a very high price point to a high-end consumer. I don't think that's thinking product, thinking consumer, thinking scientific outcome first. I would say be militant about that product that you serve to the consumer and that you're actually serving value on the table. That to me is the core of a consumer business. It's product.
And once you build that high quality product, how should somebody think about getting it across to the consumer? Should it be branding led? And there's a lot of work happening around personal brands and so on to be able to get that message across. Or do conventional channels still do their job really well?
So we are an omni-channel brand and 50% of our sales is non-quick commerce and online. So a large part of our business still comes from offline. And you have a point of communication even in an offline store, right? So when you go into a Reliance and DMart doesn't do visibility, but Reliance does. You do have points of communication at all consumer touch points. But you also have new age marketing. So you do have performance marketing within a quick commerce channel, within the Amazons and Flipkarts of the world. I think messaging should be consistent. Like the yoga bar way of messaging is the best way money can buy. The best protein bar money can buy. And what we're essentially saying is, bring us a better product at this price point and we will return your money. And that to an Indian consumer is extremely discerning. Because we as individuals, it's our society culture, irrespective of who we are as people, that we get value for the money that we put on the table. And other things on the brand you have to build through colors, through design, and be consistent in whatever is that product delivery.
And through this journey, Suhasini, you had raised capital. So maybe there was some capital to deploy in brand, but you never chose to go down the celebrity route or even television ads and so on. There would potentially be some sort of a pressure to try a bit of that. How did you duck it and why did you duck it to begin with?
So the TV ad format is simple. Like you just look at all new age brands who have done TV ads, which is ahead of their distribution. You need to be in minimum 200,000 stores. If you're not distribution led, you can't afford to waste money on mediums that don't generate ROI. That's just not commercially viable at all. And we don't pay a celebrity. Like I am one of those early people who've always said that my consumer is not making a rich person richer. Like, that's not happening with this brand.
Yeah.
We will, if it's possible for me to bring down the price to 25 rupees, I will do that. But I'm not going to take the price up because some celebrity has to endorse it. There was a lot of pressure to do D2C in the early years of our journey. Not in the early years, but towards our, because a lot of D2C brands were evolving. And there, obviously food doesn't have those gross margins. It's impossible to actually generate the kind of margins that personal care brands generate because, where 70% gross margin, etc. is sitting. So you have to understand the channel and you have to understand the economics of the channel.
Sure.
There is a regret that we didn't spend more. We should have, because we would have had the larger outcome quicker. But at the end of the day, it always comes down to the math. Life comes down to math. Personal outcomes come down to the math.
Correct.
What is the cost involved in something and what is the outcome?
Yeah.
Actually, life is pretty simple that way. So I feel like you're not going to get different outcomes from everybody else unless you're doing something dramatically different. And we were not doing something dramatically different in our marketing that our ROAS was going to be very different.
I think that makes a lot of sense. Like, one playbook for one part of the FMCG categories do not carry it to the other parts because the margin profiles are very different. And therefore, potentially, when you invest into brand, you have to think very differently depending on what your, let's say, margin rates are.
Also, what is the distribution channels that you're going for? Like, if you're going to be a D2C and quick commerce led brand, maybe the strategy would be slightly different from a company that wants to be omni-channel.
Sure.
But the omni-channel brands, you make a lot more money in your offline than you make online because you don't have variable costs. So I feel like understanding cost structures, understanding distribution channels, understanding trade and what works for trade is very important.
And during this process, you invested heavily in quality. I think your products are one of the few in India which are FDA approved, which is like approved for sale in the US. Why did you even have to do that, given that your primary market was India?
The US FDA had released regulations at that point of time that what constitutes a healthy snack. And they'd said that only 20% of the product needs to be protein, less than 20% needs to be sugar and carbs. You need to have at least your primary first 3 ingredients as whole grains, nuts, seeds, something. They had these regulations. It was called Smart Snack approved. We said, we were the first company that said, we will give India the product that they deserve to eat. We will not be dictated by what MNCs think that India deserves to eat. We will create products that US people think is the best product that comes out of India. So we are actually, in Maldives, we are number 2, right after Kellogg's.
Really?
In Nepal, we are number 1. We've overtaken. So for us, that early decision-making process has now spurred the next wave of growth. So I'm saying, you make that investment upfront because you always say the Indian consumer deserves the best value. My next theme in life is saying that Indian consumer brands deserve to be everywhere in the world. So you start making brands that somebody sees in Times Square in New York and says that, listen, this is as good as anywhere in the world. That's going to be my next focus of what I want to work on.
But this hope and this objective comes with higher costs. Like, obviously, when you ramp up on quality, it ramps down on margin. How did you reconcile that?
So when we sold to ITC, our gross margin was pathetic, and we've over a period of time, because of volume increases, because of sharpening your vendor relationships and all of that, you kind of keep taking it up. I never want to punish the consumer for the stuff that I have not operationally done well. I will punish myself. I will punish the business, right? I say that this much has to be delivered at this price, and we were crazy. Like, our supply chain works like a tech company, and our factory runs like we've not skimped on any of our machines. It's like when you go in there, you'll think it's like a place which is like a hospital level cleanliness and quality. So we put the pressure on our ops teams internally. And, that's how we make sure that the consumer gets that price. We don't skimp on quality.
Amazing. One fun part of being an entrepreneur, some entrepreneurs don't enjoy it as much, is the investing in fundraising or the investor side of things, right? Elevation also has invested in very large scale outcomes. You must have pitched to a lot of folks and potentially heard a lot of no's as well. How do you sort of bounce back from that?
Funnily enough, the Elevation investment was very easy. It was an inbound.
Okay.
Because Elevation was tracking what was trending on Amazon, and they decided to take a bet. So most investors have a thesis They have a thesis and then they find the companies to fit that thesis, right? Because as investors, they want to invest in the future. That's when you get, phenomenally large outcomes. So that fundraise was easy. I think the strategic process was very hard because the strategic process is a true report card of your business, because all along you're being influenced and directed by first your own process of what you think an FMCG company should be. And then the investors who have not really built consumer businesses. So they think that 100 crore revenue is great or whatever. But strategics show you the strategic process was, I don't know, I could at some point write a book about how you go about the strategic process, but it's a report card. Like that process was very, very hard.
So strategic process is when a very large company in the category comes in and either invests or acquires a company like this.
Yeah, they teach you everything right from, I think I changed the way I learned accounting with, strategic company actually only records the cash that they collect as revenue. I have truly learned what it means to have category share. Category share is more important than absolute revenue numbers. Having large category size in categories that are growing fast is far more beneficial than being a large revenue business in categories which are very fragmented.
Amazing.
Like it's not very valuable to have a whey business that's 200 crores where several regional players and several players have 200 crores, while it is much more beneficial to have a 30 crore business in bars where you are 20 or 30% of the category.
I think this is very underappreciated. Like you're saying that even if you're operating in a small category which is growing rapidly, having a large market share is much more important than having a large
revenue base out of categories that are largely commoditized.
Which means that, and actually before I go there, why would this be the case? Like articulate, like what is the implication of this?
Yeah, because the value of a business compounds and the ability to generate profit from a business compounds when you dictate category. You can never make money in a largely commoditized market where consumers will switch just because somebody gives a better price. So if the benchmark price is set, like what is happening in the wearable segment today, there is no reason why anybody is choosing one brand over the other unless you have sharp differentiation in design, quality, process, product. Like the reason Apple is because a consumer who wants Apple doesn't go anywhere else. And that can only happen when you are either a category creator or have large share of the category. When a consumer cannot see the discerning difference between a product, which eventually happens in food, it's very easy for people to claim the same thing. So category share is what protects you in actually creating a profitable business line.
I think this is amazing because the impact of this is that founders should go deeper in their own category as opposed to expanding laterally into other categories, which is like a temptation to grow the top line revenue.
Exactly. No, and a strategic will always tell you that. Like a strategic is less likely to buy a 250 crore business which has a 5% EBITDA, but in a really large market doesn't have a distinctive name or category share, than it is to buy a 70 crore business where the tailwind is very clear that the business will eventually compound purely because of its category share, and consumers are making a conscious choice to buy that product versus anything.
I think this is a fascinating insight. I hope more people talk about this. So, Asin, going back to the question on relationships with investors, when the chips are really down, how do investors react at that point? Is there friction? Is there hand-holding? Like how does it actually play out?
When Elevation had put in their 65 crore check, COVID hit 2 months later. The money was in the bank and we had negative sales because we were a GT company. And all of my returns came back from the store because the stores will only keep things of larger companies because the demand pool is much higher. And my head of online sales quit to join Kellogg's.
Wow.
If I were the investor, I would have freaked out because I'm answerable to my LPs and I've just put in this large check and what is this business doing, right? But I think every single call that Elevation made, are you okay? Are your workers okay? Are you okay? Are your workers okay? Because, and I think the true character, much like in business as in personal life, is usually seen when things are not going well. I would say we were fairly well taken care of. Like we were pushed maybe in the good times to do more and more and drive outcomes, which was also annoying. I'm not saying it's not annoying to be constantly on a treadmill and to increase the speed button.
Yeah.
But you do remember the times when things really hit a shit show.
Yeah.
People still really were nice to you and they asked after you.
Yeah,
I feel that's valuable.
It's one of those parenting things, right? You have to constantly goad your child on to do better when they are doing good.
Yeah.
But at the same time, when the chips are down,
Yeah.
you be
saving.
around
Yeah.
to.
Yeah.
And we are also very fortunate to have elevation in the mix. I deserve.
Yeah.
And you know, for us, Yoga Bar was always around, but it sort of burst into the pink papers when the 500 crore
Yeah.
ITC deal happened.
Yeah.
And I know that others were also sort of courting you. Walk us through this whole strategic process that happened. Like who approached whom? How did you decide whom to go with? I think we learn a lot from that.
So we were not looking to do a strategic sellout at all. So Nestle actually first approached. It was an inbound conversation. I think Nestle literally wanted to buy only the muesli business and out of the bars, only the breakfast bar. Because the way your teams are set up in large companies is you have certain category managers, and a category manager can only manage those many SKUs.
Sure.
So having like a certain depth in category is very important. And at that point of time, we were already, third player in muesli, but now we've become second. But and it was very important for them to get their breakfast play right. So it was inbound, and the conversations went on and on and on. And then it got to a point where we needed to take a call whether raising additional money would actually give differential outcomes to our investors, because it would also mean a certain level of dilution. All of us got together, did the math, and we said, listen, it makes sense now that if a strategic outcome falls in this range, it's the best financial outcome for everybody on the table. And that's how we sort of started thinking about it, because GT expansion as well, a strategic, that contribution to the business is about 150 crores. You need to set up teams, processes, expand. There is a forward investment that you make, which a strategic player comes...
Accelerates immediately,
right? So then we ran a formal process, and then the reason why we were most keen on ITC was because ITC was okay to do multiple categories and none of our products would be shared, which for us, it becomes an emotional attachment. You want to keep everything and you want to... The financial outcomes were almost similar. I would not say that any one financial outcome was different from the other. So we had everybody in the mix. We had Zydus, we had Dabur, we had Nestle, we had ITC, and then you put down the pros, you put down the cons, but we like the team at ITC the best. And I think, funnily enough, that gut call has played out the best for us. Now we do have a great relationship. We will help with growing their other brands and making, millennial first in some sense, Gen Z first in some ways, because you'll also give a different lens. So that's also a classic example. You put in a different lens for their marketing and branding as well.
So the combined value is sometimes much more than the value of the two parts individually. And, did you at some point feel the sense of loss of control, or the fact that you have to check in with ITC on a certain decision?
They've kept it. We've grown 4x from the time ITC bought us in a time span of less than 3 years.
So you've actually probably outperformed
We have outperformed our original plans. The glory is also ours for what we did in the 3 years. But if we had failed, that would have also been on us. So I'm saying you have to take the good and the bad. It's great that it turned out to be good. But if it was bad as well, it would be completely our doing. So we were we operated as because we weren't even consolidated in the end results. We were less than 50% holding, so 47% holding. Founders still had 27% of the company and all of that.
And it's amazing. And I believe the investors have also stayed on.
Everyone stayed on. And that's what spanned out for everyone, right? We all had defined a certain outcome where we would feel that this deal would also make financial sense for everybody. And it's played out.
I think it's a fantastic case study, because the founders are continuing to run the operations. The investors continue to benefit from the upside of the combined entity.
Which we were we had the option of not doing that. But I feel like life is about long-term, everyone feeling that everyone thought of somebody else. You only build relationships when someone truly feels that you did something that took from you to give to somebody else. I'm a big believer. It might be net negative today for a very long time, but at some point, it will play out for you. And even if it doesn't play out for you, this is the right thing to do. It's a value system. You have to give. You have to leave on the table.
Yeah. I think that's something for most founders to learn from, even in terms of like how they think about employee equity, for example. Most people think it's dilutive to the founder and so on. But again, the combined value of living the journey together in a positive environment, I think has far more like energizing effects.
I also say that it also manages the stress very well. I never wanted to overvalue my company. I consciously, like companies for the same or lower revenue than us, got valued 4 or 5 times more. And people would ask me, how do I feel about it? I would say like it's a sure shot recipe for deep mental health issues and also like doing things very haphazardly. We were a very steady boat. Like we were never going to put our business at a risk where we would be at lower valuation than the last round. And we would deliver outcomes that were commensurate. It was never a very like, even when the story got out of the ITC acquisition, most people believed it was, the markets actually believed, the public markets believed that we left money on the table. So, and that's how I want it to be. Like that's a very conscious call that we as founders.
No, you do see that in a certain set of founders where they're very conscious about leaving enough value on the table. Especially now, a lot of new age companies are going public. They're faced with that decision point in pricing the stock at issue, that should it be hyperpriced or slightly lower.
It actually never makes sense for the founder to hyperprice in a public markets issue. Except for the small quantity of secondary that you end up doing prior to the round, right? So I actually don't even understand as a founder running the business, you're much better off actually keeping the public market investors very, very vested in your shares.
Yeah, absolutely. And the positive impacts of that in the long term are crazy. One happy outcome out of this is the amount of personal cash that you create and I know that you're not very comfortable talking about it, but I think it's an important part of the journey of such a lot of people are inspired by that. How did you think about the amount of equity you wanted to sell to begin with?
So I never left myself at that point where I felt like cash should be a driving decision. How much equity I partake with was a decision driven by how much made sense for the other person as shareholding. It would not have made sense for Elevation to have less than 25 because they need a certain skin in the game for them to show outcomes.
Makes sense.
It would not have made sense for ITC to take much less than 50%, around less than 50%. So I would structure the deal based on what made sense for the other person and what made sense for me.
And it's almost like you're coming last in this whole thing, and consciously so.
It is the way I've behaved. I do believe that I have it might not have seemed obvious at the time of taking that decision because I was faced with the choice of actually incrementally super benefiting myself. But I will not walk that path. And I think today that a good night's sleep is extremely valuable in life. It's your primary asset. So I don't function like that. I don't function like that even when it comes to the business. I'd much rather leave money for the consumer. And I will do this for the rest of everything that I do because I think it's the right way to do things.
And when you do get this liquidity, you're faced with a set of choices around buying a house, investing that money, and then again within equities, fixed income, etc. How did you go about that process?
So we did do secondary even at the time that ITC bought, right? We sold some part of our shares. I only do house investments such that the decision of the house doesn't control my own life. So of course I did it to the extent that I got the capital gains, and then I can see that the return on buying that house was financially viable decision to return more than the markets. So net of the tax benefit, if selling that house in 3 years time frame, now 2 years time frame, was incrementally better than actually investing the net of tax proceeds in your index funds, should you make the decision to buy the house. It was a purely financial decision because I will keep moving wherever my kid moves for school. So I don't want to be tied down and I feel like a lot of people say that I can't go to the school because my house is here. And I feel like that's a detrimental way to live life. You should optimize for what is right for the family, right? So I will never make investments that actually tie me down. And at the same time, I will not also do investments that are risky. Like I'm a very risk averse. You put the money in, you don't really worry about it. You grow the way India grows, which is a great growth story. So I just put in the index fund. And you don't look at it every day. At some point of time, it will grow the way the market grows, and it's perfectly good return. So that's really my investment philosophy is the investment should not control your personal life decisions, which is why you never go crazy about your house.
Yeah.
You never lose sleep over it, and you don't do things that you don't understand.
Yeah.
Simple investment philosophy.
I think a lot of people don't put enough value to not losing sleep.
Yeah.
And I think most times it's not easy to understand what that actually means.
Yeah.
One is that it means less stress and so on, but it also means great decisions.
Yeah.
Because when you're stressed, you end up taking crazy decisions. We've seen people who were extremely exposed to equities during 2008 or even during 2013 take very suboptimal decisions with life, right? And I think that's where not losing sleep becomes very important.
I can't emphasize enough that doing complex. Wait, actually, the incremental delta on the gains is just not worth the incremental cost on life. Like I have this thing where I tell my friend, I don't think we envy our wise friends as much as we envy our rich friends. If we start envying our wise friends, we probably make better life decisions.
Yeah.
So I've started doing a bit of that.
I think it makes a lot of sense. And actually, on that note, the incremental delta on the returns is not guaranteed.
It's not guaranteed.
But the cost is certainly guaranteed, right?
Yeah, the cost is certainly guaranteed.
So then when you think about even laying a bet, you think about like, okay, if this cost is certain, but the outcome is uncertain, should I really make that bet? And most often the answer is no. And Suhasini, on that happy note, thank you so much. I think we're all wiser for this podcast, not only in terms of business building, health foods, but also your personal ethos, I think has a lot to learn from. Thank you so much.
Thank you for having me, Sandeep.
Thank you.